Mortgage rates only kept climbing in the last week. Buyers in this real estate market notice these affordability changes, and so we can see in the data fewer home purchase offers, slightly climbing unsold inventory, and slightly more price reductions for the homes that are on the market. This is the same pattern we talked about last week. The first half of the year had kind of surprisingly resilient sales, but that is slowing again. Mortgage rates are at their highest level in 20 years because the economy just keeps reporting strong data. Every uptick in mortgage rates leads to a downtick in the number of home buyers in the market. Rising rates makes more inventory. So how much more inventory will we add this fall? Well, as of now, the slowing signs are subtle. The housing market is much different from last year at this time. Last year, rates climbed dramatically, and so did inventory. Now rates are inching up, and so is inventory inching up. If mortgage rates jump to, say, 8% or higher, that's when we'd see big changes in home buyer demand and in inventory and in home prices. So keep watching these numbers here. That's why at Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data, and we make it available to you so you can see it before the traditional channels. I'm Mike Simonsen. I'm the founder of Altos Research, and let's take a look at those signals. It's now late August 2023. The inventory of unsold single-family homes on the market ticked up. It now doesn't look like next week will be the peak of inventory for the season. It looks like inventory will keep climbing probably into September. There are now 495,000 single-family homes active, unsold, on the market. Inventory rose by just under 1% again this week. The inventory climb at the end of August is not unusual. It's not a rapid rise, but it also doesn't appear to be leveling off. So inventory often peaks the last week of August. In the fall is fewer sellers. The supply keeps shrinking through the holidays. But now, because mortgage rates have been notably higher for the last several weeks, we also expect inventory to keep climbing into September as fewer buyers are making offers on the existing inventory. There are 10% fewer homes on the market now than last year at this time. Last year, inventory spiked March through July with spiking mortgage rates. Then it leveled off a bit. So this week, inventory lost ground on last year. The inventory gain week to week was more than it was last year at this time. That's the first time that's happened in many months. Last week, there were 10.5% fewer homes on the market. This week, it's only 10% fewer. So that's one of the subtle signals that higher mortgage rates have slowed this year's home buyers again. To understand the future of housing inventory in this country, remember the Altos rule. The Altos rule says that the more available inventory of homes to buy is the result of higher mortgage rates. If rates climb, so does inventory. If rates fall, inventory will fall. That's the Altos rule. You'll have to wait 2 weeks, though, until after the Labor Day holiday for the next video, because the Altos Research market videos are taking the week off next week for the last vacation gasp of the summer. You can follow HousingWire's Logan Mohtashami, who will, I'm sure, report the inventory numbers next week if you want to keep your eyes on it super close. We'll be back in 2 weeks. There are 365,000 single-family homes in contract right now. That's up a fraction from last week and 10% fewer than last year at this time. New pendings of single-family homes going into contract this week came in at 63,000 versus 70,000 last year. So in this chart, the height of each bar is the total number of homes in contract each week. The light red portion of the bar are those newly in contract. The sales rate has slowed since rates did their latest jump over 7%. In fact, I'd expect the NAR headlines to keep falling on the pending sales measure as well. So we could see the sales rate tick down to, say, 4 million annual on their seasonally adjusted annual rate of pending sales in the next couple of months. Keep your eyes out for that. I'm looking forward to the time when the real-time data starts to show growth, and the sales rates look more bullish than the headlines, but that's not happening yet. So as we watch the new pending home sales each week, the next trend we will be looking for is how quickly does the new pendings rate shrink this autumn? How quickly does it shrink? See in the chart how the light red portion of the bar shrank each week last year really quickly in the fall. That gap started the year with 30% fewer homes in contract than the previous year. That gap narrowed to 10% fewer. So there's 10% fewer homes in contract now than the previous year. So we've been catching up, but we've been unable to get closer than that 10% gap. So the market was accelerating this spring, but it is not doing so now. And I suppose the negative swings on the other side of the coin for what I've called the soft landing in housing. Housing demand cratered, but prices didn't crash. So home prices declined in July and again in September, October last year, and then recovered a bit in the first half of this year. But now demand is softening again. And so it'll keep home prices from appreciating much from here, even though the first half of the year we had more buyers than sellers. So American home buyers are very sensitive to mortgage interest rates. And while higher rates have hurt affordability for so many, it's really the change in those rates that spur changes in demand. So earlier this year, we had more buyers than sellers, even with rates in the sixes. When rates jumped to 7.2, that's when we see the demand data react accordingly. So it's not the absolute level necessarily of the mortgage rate, it's the change in mortgage rates that people should be paying attention to. We can see it in the price reductions data too. Price reductions are about to inch higher above 2018 and 2019 levels again. 35.5% of the homes on the market have had price reductions. Price cuts always tick up late in the summer, and this year's seasonal increase is speeding up just a bit with the higher mortgage rate. So each week we have slightly fewer buyers making slightly fewer offers, so slightly more sellers cut their asking price. So watching this price reductions curve has been so valuable lately, so insightful. In this chart, each line is a year. You can see last year's light red line started climbing in March. That told us the pandemic frenzy was over. In September last year, price reductions spiked again with mortgage rates. That told us that demand stopped cold in September. This year, the dark red curve shows us how rapidly the market was recovering starting after the first of the year. That told us there was a floor on how far home prices could fall when they were falling at that moment. So it really highlights how effective this stat is for understanding the future of home sales prices. Right now, 35.5% of homes on the market have taken a price cut. This is a normal level. It is rising. It's not rising fast like last year. So it's not a strong signal, but it is rising faster than recent years in August. So that tells us that sellers are seeing fewer buyers than anticipated. The buyer slowdown right now means that any home price appreciation we've had year over year is weakening and actually may be in jeopardy. So tracking home prices on the active market, the listed homes, is really insightful also at the local level. Right now, for example, we can see that Austin, Texas has the most price reductions of any big market in the country, and it seems to be climbing. Over 50% of the homes in Austin now have taken price cuts on the market. And you can use the Altos data to understand local differences, and it's so important right now. The median price of the homes on the market is $449,900. That's unchanged from last week and unchanged from last year. Just a fraction higher than last year. Prices tend to cluster on the big round numbers, so in this case, $450K, with a big group just priced under that, $449,900 for their search purposes. So we'll be at this, we have been at this home price, $450,000 home price plateau for a while, and could be for another few weeks. Home sales prices in the future are not falling because we can see that the asking prices are very stable. So much more stable than they were last year at this time, right? So that's a very different signal than we were getting last year by watching this dark red line. Now, the median price of the newly listed cohort is $399,000. Again, that's unchanged week to week. That's the light red line on this chart. The price of the newly listed homes is up 1.3% over last year at this time. So, this is when homes go on the market. The sellers and the listing agents, they know where the demand is. They know how many buyers are. They know where overbidding is happening, and they price accordingly. So the price of the new listings is an excellent measure it's a leading indicator for where sales prices will be in the future. Last year, the market was slowing so quickly that the comparisons now to last year will look easier. But this year, the market is slowing gradually. So you can expect the annual home price appreciation to look more positive, even though we are seeing a slowdown right now, slightly negative momentum. It looks like we'll end 2023 with home prices up a few percent over where 2022 ended. When we look at the price trends of the homes that are going into contract, we can see the earliest proxy for sales, which will actually get recorded, closed in September and October. You can see that the last several weeks have put a little downward pressure on what home buyers are willing to pay. You see how the dark red line was above last year for a few months, and then in recent weeks, it's that dark red line's like compressing closer to the light red line. That's the sales prices giving up their annual gains with the higher mortgage rates. The median price of the homes that went into contract this week is $378,000. That's up a tick from last week and just over last year as well. But you can also see in the chart, the dark red line is drifting lower. So now the sales price comparisons get a lot easier in September. September last year with that big rate spike in 2022. So assuming we don't have another mortgage rate spike now, the annual price appreciation, the annual measure will get easier it'll continue to improve. On the other hand, if we see 8% mortgage rates, there's no reason to believe that home prices can't gap lower again like they did last year. Again, this is a very clear reaction to the latest surge in mortgage rates. We have fewer buyers, and those buyers are willing to pay just a little bit less. The opposite is true too. If rates were to drift lower, you can expect more buyers, less inventory, fewer price cuts, and higher prices in data measures like this one, the price of the newly pending sales each week. Today is actually very clear right now. And that's why we track every home for sale in the country every week. There's so much signal in the active market data, and the lagging headlines sales prices don't tell you. If you need to help buyers and sellers right now, go to altosresearch.com, book a free consult with our team. We'll help you talk about the local market with your clients and prospects today. So there's a link in the description below to click that. Join us at Altos. Just book a free consult with our team. As a reminder that this video will take a week off next week with the last vacation hurrah of the summer. We'll be back in 2 weeks just after Labor Day. Meanwhile, follow Logan Mohtashami on the HousingWire for keeping tabs on what the data is doing while the rest of us are on vacation. Thanks, everybody.